And thank you so much to Arpit Parikh, who's joined us here as the session host. So Arpit is a seasoned finance professional with over 15 years of experience in financial strategy, business planning, and valuation. He's a qualified chartered accountant and is currently pursuing the Chartered Financial Analyst designation, CFA, farther deepening his expertise in investment analysis and financial modeling. In his role as director at Professional Multi-Financial Services Limited, Arpit works extensively on financial modeling, business forecasting, and investment evaluation. His day-to-day work involves analyzing company performance, structuring financial models, and providing insights that help businesses and investors make sound financial decisions. Arpit's strong foundation in financial principles, combined with his analytical rigor, gives him a deep understanding of how to value early-stage businesses and assess startup potential. His perspective is grounded in real-world experience, making his insights highly relevant to today's discussion on the financial modeling and valuation of startups. So please join me in welcoming Arpit Parikh.
Lovely, lovely. Thank you very much, Jeremy, for this lovely introduction. And I'm audible? Yes? Okay. Yeah, thank you to the entire Venture Studio team for having hosted me today for this session on financial modeling and valuation. I'm sure every one of us, whoever have started up as entrepreneur, everyone want to understand and go further deep into how we can build some simple financial models so that we can understand certain basic financial jargons, as well as whenever we are going and meeting to our investors, we should be ready in some way. In order to start, I will just share my screen. Yeah. So as a topic of today, first we'll start with financial modeling, then we will move on to valuations. If in case any of you have any queries, I would request you to kindly post it on the chat box so that if we can address it there and there, or maybe post the session, we can take it up, right? So yeah, so that is how we start. So basically, what is financial modeling? For anyone, it's nowadays a very in thing to call financial modeling as a jargon also, which is basically nothing but projections. Projections of any company which we are wanting to do is basically known as a financial model, right? So what are the basic elements when we say a financial model? What are the basic elements to the financial model? As we have noted here, it's basically preparation of financial statements, wherein we start with the assumptions, wherein because it is the most important thing whenever you are starting up, right? That assumptions has to be very rigorous and tested, and from the assumptions only the other statements such as the profit and loss account, the balance sheet, the cash flow statements are going to be made. Now, why are these important, right? Because whenever you are going and meeting an investor, the most important thing he will be grilling you will be on the assumption sheet, right? All other things are derivatives of your assumptions. So your assumptions has to be very strong and very firm and very much tested also whenever we are going to an investor. We will also see an Excel file in order to run you through how a financial model works. I'm just going through some basics so that you can understand what we are going to do there as well, right? So basically, a financial model is nothing like assumptions, cash flow statements, balance sheet, profit and loss account, and finally preparation of the entire financial statements. So why do you need a financial model? First and foremost, you need your financial model to understand your own business model. Now, how is a financial model different than a business model? A business model will be generally, you will have heard a lot of times, what is your company? How are you going to do business? Are you a B2B company? Are you a B2C company? Or are you a B2B2C company, right? All these are different models that are there in the market for you to, make your product reach the end customer. How are you going to do that? you have to test all of these through your financial model. That is why your business model becomes very easy to understand whenever you are putting it across in the financial model. Second, very important thing in today's world, we are all going to go out in the markets to the investors, to the incubators to, get money for capital for your businesses, right? But how much money is required? If you are a B2C company and if you are saying I just need 1 crore rupees, it may not sound proper because it needs a lot of cash burn, right? So we have to understand what is your funding requirement going to be, right? And how will that come? Your financial projections should finally tell that okay, this is the amount of funds which will be required by me whenever I am going to meet the investor. Similarly, to understand, one is total funding requirement and second is when all also you are wanting to raise that funds. For example, if I have a requirement of total 20 crores and if I am going to an investor right away with that sheet, he will ask, but you need 5 crores only in the first year. Why are you taking the entire 20 crores right now? And it will be sound on the entrepreneur's side also to take as little capital as possible during the starting years so that they can dilute lower, right, in the initial years itself. And because the valuations are generally very smaller at the starting stage, so it is always better, right, to understand what amounts are required and when they are going to be required. So let me start up with some revenue assumptions. I will now share an Excel file. Yeah. So I have tried to make some basic sheet wherein I hope my screen is visible so that everyone is able to see that, right?
It's
Okay.
visible.
Yeah. Okay. So now I have tried to make a case study wherein this is I have taken one of my portfolio companies wherein it is a cyber security company, and how we are going to build a model. I have tried to put it as simple as possible so that you guys can understand where we are going and how we have to build a model. So for example, you are a cyber security company. First and foremost, any company or any investor or any entrepreneur, what we need to do is first build your revenue assumptions. The reason being, your product can be lovely, you might be doing phenomenal research, you might have patents to your products, but if it is not a commercially marketable product, the business sense or the commercial sense to it to the investor will be not there at all. So even though you might be at a stage wherein right now you are at a research stage, you have to understand and go to some research also on the marketing side and do that whether your product is going to be acceptable in the market or not. Otherwise what happens is we can do huge number of research, but if it is not going to the market, it is not going to be of any use. So always do a good thorough research of the marketability of the product and start always with the revenue assumptions. So for example, in this cybersecurity company, right, generally for a cybersecurity company, the clients are, finance companies, NBFCs, large SMEs, large corporates, all of them will be our customers or clients. So I have selected a business model wherein we will be doing a B2B kind of a approach, so that because I am not going to bill directly to some consumer, for me businesses will be my end customer, right? So now you have to go again, grill yourself. How am I going to approach them? For example, it is very difficult to get a meeting with a CTO of a company and have an a discussion about your product. Also, whenever you are going and meeting them, it need not be that in that meeting itself your conversion is going to happen, right? So be very thorough in what we are projecting, because I come across so many financial models wherein from day one you are projecting that the sales is there, I will be going and meeting this many clients, and out of that straight away 70-80% will get converted. Be truthful to yourself whenever you are building a financial model. And one is, why? Because financial model will also draw a picture to yourself where and how you will be standing whenever you are going to the market. Presenting it to the investor is always different, but when you are actually, wanting to build an enterprise, you have to know also actually also how you are going to do that, right? So you have to understand, for example, in this case, I have built that I will be meeting two CTOs in a month, right? Acha, one more important, very important assumptions. And whenever we are doing is, we have to build the first 12 months very thoroughly, and it has to be built monthly. One more common problem which I see, a lot of startups come to us straight away building a yearly projection. It's okay when you are giving it to the investor, but whenever you are building the model for yourself, build it monthly, because whenever you will build it monthly, you will exactly understand how we are going to fare. Because I understand the next 3-4 years are not very foreseeable, but the initial 12 months whenever you are going to start a business are always going to be foreseeable, right? So you have to project that 12 months in a month, so that you understand monthly basis where you are going to be. You can even put it in an MIS. Okay, I had budgeted for this much, how much I actually achieved, right? All that things, this little things, improve your model a lot. So that is what I would like to. So that is the reason I have also built this monthly, because the first 12 months have to be always monthly. So suppose I am going and meeting only two CTOs. As I said, be truthful. Don't, think that, okay, I will be able to meet 10 CTOs in a month. It's very difficult for us to, get these appointments. So understand, do your research there also. If you have some better connects, definitely you can put a higher figure also. But this is how I have started, that I am meeting two people, two clients in a month, right? In the initial 3 months, I'm not doing any conversion, right? Because I know that my sales cycle is going to be a minimum of 3 months. Very important to understand this again. Your sales cycle only you will know. How is it? For a D2C company, it can be one day. For a B2B company, it can be 2 months, 3 months, 6 months, anything, right? In defense companies, we have seen one single order come in six months time, right? But you can always adjust your financial model accordingly, because that one order can be a big order. That's okay. So always be very thorough in your revenue projections, wherein you are first building to the granular level, that how many people you are going to meet, what will be your conversion rate, out of that how many will be your paying customers. So if you see, I have done a 30%, but this 30% is of the April month, right? So I have done that, okay, from April I will be able to convert maybe 30% of whoever I'm meeting there, right? And gradually build the model. So from 30 I'm going to 40, then 50, then 60. You have to take a learning curve and accordingly only build the model, right? Similarly, again, a very important prospect here is billing per client. This is going to be very tricky, because there may be products which might be worth just hundreds of rupees, and there might be products which might be single order, maybe even 1 crore rupees. So you have to understand what are your market practices, what are your competitors billing, right? If you say, okay, this is a very unique product, we understand that, but right now, similar to your product, or uh, if I am not using your product, what are the costs that I am going to incur, right? Whenever you are going to meet the client, these are your standard questions which are you are going to address. So be very clear what will be your billing per client, and then accordingly you will come at a monthly revenue, right? This is how you have to build the revenue. It has to be very thorough. It has to be very minute, as much minute as possible. You have to go there, right? This is the first thing which I wanted every one of you to learn. That is the revenue assumptions. Then one of the most important cost which will come to a cybersecurity company is going to be employee cost. So I have built an employee cost assumptions also. I have seen again, many people just saying, okay, I will hire 10 people in this year, 20 people in this year. I will have a developer who will be, I will pay him only 50,000 a month. Again, go to the market. Today's employee market is very tricky. you don't find good people, at a lower cost, especially if you are thinking of building a company wherein you have to be you are going to have a revenue of crores. Don't think that you will be hiring some freshers or interns. Go for someone who are more experienced, though you might have to shell more money. That's okay. You will have to explain finally to the investor why you need the money, right? The major money you have to take is for the employees, for the marketing. So why cut corners there? Secondly, again, don't just build, okay, I will be saying that 10 people in 1 year. Go monthly, because it's not easy to hire people. For example, sometimes people say, okay, I will just hire 10 people in a month. It's not easy. You don't get good resumes today, right? So factor in all these things whenever you are building the projection. It has to be as minute, again, just like we saw in the revenue side. Here, this is going to be your most important cost. So for example, founders, I have kept, for example, 2 founders. Then there is a CTO, but see here, I have not kept the CTO right from the start. I have made him start from October. Why? Because maybe I may need some funds, I may need some right guy, for me to hire him. So understand when you are going to hire and accordingly build that. Secondly, try to put as many heads as you are going to hire, right? So if you think you will be okay with this many people, then if you think you need more people, add on to that, right? You will have to build as many people as much you need, and also build the cost to that. For example, some people will say, I have built a CTO for 5 lakh rupees, but founders only 50,000 rupees. It might be a case, in fact, it is in most of the cases, that the higher management people are coming at a higher salary, but the founders, unfortunately, you will always have a term sheet with which you have to bind. And term sheets are generally, if the investor is preparing, he will also guide you how much salary you can take. I have taken here a very basic minimal salary, but I'm just stating it that I have seen many instances wherein the founder salaries are even lower than the CTO's salary, right? Because you need to have good talent. Only if you have good talent, you are going to build a beautiful product. So don't cut corners there. Have as much headers as possible in your employee cost, has as much numbers as much, for example, as small as an accounts executive, budget for it, and accordingly say, okay, I will have a accounts executive for this cost, a CFO at this cost, all these things. And finally, once that is done, you will then have your entire finance employee cost, by multiplying the number into the cost. So when we are doing this, assumptions, as I said, is going to be very critical. Both revenue as well as cost will play a very important role when you are building the entire projections or the financial model. Now, a derivative to this all assumptions, we go to the P&L. What is a P&L? A profit and loss statement, or a revenue statement, to say it simply, right? This is something wherein you will get whether you are going to make profit or not, right? And in most of the cases, we always see that in all early stage startups, you will never be making profits in the earlier years. If you see in this company also, you are going on an EBITDA loss for almost 3 years or 4 years. We are making profits only in the 5th year, right? So you have to be realistic here again. Don't think that, okay, I will be making profit in the first year itself. The straight question investor will ask is, why do you need money? So don't think that profitability is going to be very important in the early years, right? Budget for your expenses. It is okay to have higher cost and then cutting corners there when you are not able to find a good employee, or you are doing some nice negotiations for your marketing or something like that, right? Again, for example, here in marketing and branding, I have kept some figures. Because I'm a B2B company, I don't need to spend very heavily on my marketing and branding. If you are a D2C company, 30% of your costs have to go here, right? It is a no brainer that your product cost might be 30%, and something equal cost will go in marketing, advertising spend also. So again, this is based on the model. B2B, not much of a marketing and branding cost, but B2C, heavy marketing and branding cost, right? So whichever model you are selecting for your company, you have to accordingly draw down the entire expenses. For example, as I have noted here, some expenses are direct cost. In cybersecurity, my direct costs are capitalized. We'll go there again because we will be making the product initially and then selling it, right? So direct cost as such doesn't come. Employee cost is the major cost, right? Business development cost or partner cost. Again, I may not be always be able to reach the CTOs of all companies directly. There might be intermediaries. Sometimes you want to export your services, right? Think of that also. If you will have intermediaries and you have to share some revenue with them, right? So you have to account for that. Either it can be a partner cost or it can be an advertisement cost, commission cost. You have to account for that, right? Then marketing and branding, again, it can be a percentage to your sales, or if you feel okay, I will be having some marketing budgets, maybe 50,000 a month for my B2B product, account for that and see wisely whether you are able to meet that or do you need higher money, right? Also, whenever you are, why doing this monthly exercise? Because when you are achieving month on month, you can iterate also, right? If you think that okay, 50,000 is too less, I may need 5 lakh rupees, please go ahead and iterate your entire financial model so that your numbers will throw the correct outcome, that okay, I need this much capital, right? So it is very important again to budget for all these expenses. You can, general heads, what we always say are employee cost, marketing cost, direct cost, IT. Nowadays IT becomes a big cost, because a lot of times subscriptions, you need to do a lot of subscriptions in your companies. Again, budget for that. Admin cost, you can always say okay, your accounting, your outsourcing, your legal, your finance. Especially whenever you are doing fundraising, you will have to incur a lot of legal cost, lot of services cost. Account for that, right? Don't just think that okay, I will be okay if I, maybe 50,000 rupees should be okay for CA services. For regular work it might be okay, but whenever you think that okay, in this year I am going to raise funds, budget for investment bankers cost or for some legal cost, right? All these things will come as your admin cost. Then finally, what, after your revenue less all your expenses will bring you to a number which is called EBITDA, EBITDA. You might have heard again a lot of times that okay, what is your EBITDA numbers? It is basically similar to gross margins less your basic fixed cost gives you EBITDA. It's the full form is earnings before interest, depreciation, tax, and amortization. But EBITDA is okay if you know it at all, right? So, what is going to be the deductibles from EBITDA? Three things: finance cost, depreciation, and tax. Let's go to first some balance sheet assumptions. Uh, for example, if you are developing a product, right, the product will also need a lot of capital to be built, right? So here I've just again assumed some numbers that I will be doing some capex or product development. Now this can be, for example, I have taken just 12 lakhs. This can be in crores of rupees, especially in biotech, industries. What we have seen that in the initial years you have to pump in 2-3 crore rupees. Luckily, all these incubators like Venture Studio, BIRAC, they are all giving good grants, right, to fund all these initial expenses also. So how will you know whether you are going to need so much capital? Build all that expenses here. If you think your product is going to require clinical trials, build all that things, because we have seen clinical trials also going into 2 to 3 crores. Again, not only amount, also budget for timing. We have seen a lot of times that we feel okay, clinical trial will be over in 6 months, but sometimes clinical trials take 2 years, right? Speak to your consultants before budgeting for time and money both, right? That what is the timeline that you feel my clinical trial might take, or what is the time, what is the amount that you feel that my entire spend might take. So all the product development capex has to come here, and budget it accordingly in a proper way. Once your capex is done, there is a term known as depreciation. Depreciation is something like how fast your product or how fast your plant and machinery will be replaced, right? So we generally say as a thumb rule, it is generally 4 years or 5 years, sometimes 3 years. So whatever rate you feel you are comfortable, put here. So 15% is something which we already do as a thumb rule for plant and machineries or for some traditional assets. But the new age assets, generally we go higher and we depreciate it in just 4 years. So put a small figure of 15%, 20%, and accordingly your depreciation figures will work out, right? Now let's understand working capital. A very big miss I always see in all my projections. All of you guys I have seen come to me with lovely P&Ls, lovely assumptions, but none of them I have seen come with working capital assumptions. A very big miss I always recommend, because in a lot of companies, working capital is where you need money, right? Your business might be making money for you, it might be even showing profit, but your cash flow is like, oh, where is the money? Because your all money is either stuck in receivables or in inventory. It will be foolish for a B2B company to say that, okay, I have billed you and you have made me payment. We all know in any country, in fact, for that aspect, 30 days, 45 days, it takes for people to make payments to you, right? So again, do these checks, right? Whenever you are doing these checks, you will understand that, okay, whatever, for example, if I have built, in this case, I have built 30,000 rupees in the month of July. I have kept it as receivables and it is not going to my cash flow. Reason being, I know this money I will be receiving only after 1 month, right? So accordingly build the entire model, right? So that whenever you are going to an investor, you are not stuck into working capital. So receivables, secondly inventory. If you are a manufacturing company, you will need a good amount of inventory, right? It might be 3 months of inventory or 4 months of inventory. When we say inventory, for example, if you are into capital goods, you are making some machines, right? Sometimes you might need a lot of raw material with yourself, even though you might be doing your billing or your work may start after your order is placed. That's okay, but you, for that orders also, you might need some raw materials to be always there in your warehouse, right? So inventory is again a very big space where all the money gets stuck, right? These two places, always remember, you will need money a lot of times for receivables, for inventories. One more area I have not covered here, but for example, a lot of times we see people bidding for tenders, right? In B2B companies. In that tenders, EMD amounts almost go to 10% of the order value. That money again gets stuck for almost one year, right? Again, you will always think, I have money, but where is it? Okay, you will see it is in deposits, some security deposits, which you might have given to some government agency. Account for all these things. If you are going to be into a tender business, please account for all these working capital requirements, right? So once your P&L is done, right, you will get your depreciation. We are not assuming finance cost, because generally we see all startups are funded through equity. However, if you are going to take debt, which is again a very good way to raise capital, right, you should account for the interest cost in the sheet, right? Whatever the interest cost you are going to be paying monthly, please account for it here, so that your EBITDA gets less by finance cost, your depreciation, and you are coming to profit before tax. Again, here I have not shown any tax, because I have huge accumulated losses which I can set off. Secondly, as you all are aware, if you are a DPIIT startup and if your turnover doesn't cross 100 crores, and if you have applied for a ATIAC registration, right, which is a tax exemption certificate for 10 years, all startups get, right? Any 3 years you can get, out of 10 years, any 3 years you are exempt from tax. All of you should apply for it. If not, you should do it right away, right? So these are some small things which all of you should keep in mind. Right now I have not kept tax because here I have huge amount of losses, right? So once your P&L is built, then you go to your balance sheet. Your balance sheet will have items like fixed assets or product development or intangibles, right? Receivables or inventory, other current assets or cash and bank, right? Cash and bank is always going to be there. Now, how are all of these going to be funded? It will be funded through equity, right? You will be having accumulated losses or profits, and you will be having payables. So because it's like, for example, your employees are there, you are not going to make the employee payment on day one, right? You are going to make them payments to all your employees on the 30th day. So you always, by nature of businesses, you are getting a credit of 30 days in your business cycle. So account for that as well, right? Once all of these are accounted, what you will get is a cash flow statement. This is the most important statement which is being looked upon by all the investors. They are not, at all wanting to go through your balance sheets or P&Ls. It's okay. They will ask you some unit economics there, but finally they will want to understand when are you going to make money, how are you going to make money, where your money is going to get stuck. So if you see here, our losses are the first starting point where we need money. Second is all the capex items is where we need money. Third is we need money for all the working capital. These three are always the major, utilization of funds. Always your business, regular business, to fund your losses. Second for capex, and third for working capital, right? So these three always has to be borne in mind that you do it very thoroughly. One more thing, I have shown that, for example, in this case, the total amount of funds I want is roughly around 22 crores, but I could have done it here itself, right? That okay, I would have raised the entire 22 crore here. But if I do that, I will be diluting my entire stake in the first go, and it is not going to be of any sense, because in the first year, I don't need that much capital, right? One more way to show you how much capital you need, for example, right? Build the entire model and you will understand how much money your entire fund is, your entire business is going to need. For example, in this, you see there is a negative 16 crore rupees, right? That means my entire business right now over a period of 5 years will need 16 crore of rupees to run. But how and when, you can go monthly and understand how much you want to raise funds accordingly. And that is the reason I have done a staggering of fundraise, so that I dilute my equity stakes as low as possible in the initial years, right? So this is how you basically build your entire financial model, right? It is starting from your revenue assumptions, going to your cost assumptions, then further build your profit and loss statement, go to the balance sheet, build your balance sheet assumptions, finally plot all of that and go to the cash flow. These are basics, so that you yourself can also build some small little things, right? You don't always need a financial advisor for building the entire thing. You should need him when you are going for an investor, so that you fine tune your uh, 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 understanding of your financial model. He will ask you tough questions. He will make you ready, to face the investor. Go to him for all that things. But initial building of a business model and financial model, you should do it by your own, right? And try to build always, the first thing is, build it in a monthly way, right? Let's go back to our presentation, right? So as I said, how to prepare a financial model, start with revenue assumptions, calculate, what are the methods. For example, sometimes people say, okay, sir, how do, what I have shown is one way. There are a lot of people who come to me, sir, we are working in a D2C market. How to do that? So in that case, go from a top-down approach, wherein you estimate your entire market size. There are a lot of literature available on Google, on ChatGPT, how to, what are your market sizes, right? So get that, understand out of that what will be your addressable market, and how much of that you will be able to cater in the initial years. Please again, be very mindful that whenever you are
Quick question, Arpit. We have
yeah.
in the chat here, one of the guests is wondering if these templates will be available.
Yes, absolutely. I mean, I would request Venture Studio team to please share all my workings and presentations to the entire group.
Sure, we'll just get those loaded up into Google Drive and we'll share the link in the chat momentarily.
Yes.
And then one other question was if you're going to discuss cash burn model later.
So cash burn is basically, what is cash burn, right? Cash burn is nothing but funding your losses. So as you saw in my model, it was a cash burn model only, right? Wherein I am not making money in the initial years, right? I am burning money in the first 4 years, right? I am only able to make money in the fifth year. So cash burn is nothing but having losses in the initial years, funding that losses through raising of funds in any way, right? And finally achieving break even and profitability once we reach the break even stages. I hope I have answered that question, right? We can again put the floor open for questions in maybe 5 minutes. I am just completing my financial model thing, right? So yeah, so we start with the revenue assumptions. Let's go ahead with the methods to calculate the assumptions. Like I said, top-down approach. You be very mindful as to the entire market sizing, and when we are selecting the percentage of market size, be as low as possible and then build it upwards, right? Talk to your peers, talk to your other competitors, how they have built, right? One more thing I see a lot of times, people just straight away come to us. Do your own research. You have to do a thorough research yourself, because as a financial advisor we can only throw questions to you, but research only you can do, right? Surveys only you can do, because you know the right people who you should ask your questions to, right? So try all of that, right, in the top down approach. The bottom up approach I have already explained, wherein you first understand, okay, how many people you are going to meet in the initial months, right? How are you going to build them? What will be your churn rate? What will be your success rate? And accordingly build the entire thing, right? So this is how you select the approaches. For what period do we make the financial model? Generally, as I said, it is a 5-year model. It is always advisable to make a 5-year model, right? However, in the first year, always build a monthly model. It is very advisable to build a monthly model, because a lot of times you will see at the end of the year you don't need the funds, but you might need funds during the some months, right? A lot of businesses are seasonal, right? So again, they will need certain funds during JFM or October, November, December, but they might not need funds at the end. But when you do it and break it up monthly, it will exactly tell you, okay, in this particular months you will need more capital, right? So always build a financial model for 5 years, and first year being monthly. Some jargons, monthly revenue run rate and annual revenue run rate. Generally for SaaS companies, you will always see, because they bill to the customers or end clients on a monthly basis. Sometimes if you see nowadays, for example, Netflix or a Google, right, you get 299 rupees every month or a 199 every month. That is their monthly run rate, right? So if your company is in a similar sector, use these jargons, right? Then there is average order value. This is jargons generally for D2C companies, because we always see D2C companies are billing, and AOV is a very critical indicator to understand the entire financial feasibility, right? The reason being, sometimes one of the very important costs in D2C is logistics cost. So we always say that if your AOV is higher, that's your average order value is higher, then only you are able to sustain your logistics cost as well. Then your GMV, a very famous jargon, gross merchandise value. Basically, what is the amount of sales that you have enabled at the end level? Because finally, yeah, yeah, sorry. So, uh, so GMV is something which we all see, like in Flipkart, Amazon cases, right? That they have done this much amount of GMVs because they are enabling that much amount of sales on their portals, right? So that is how we go through these jargons, right? This we have seen what are some various components of cost. First and most important is direct cost or your cost of goods sold. Then there will be employee costs, right? Again, as I said, please go as deep, dive as deep as possible whenever you are, structuring or assuming all of these costs. Then there is business development, or a lot of times in D2C companies, again, customer acquisition cost, marketing and branding costs, IT costs, admin and general costs, final finance cost, depreciation, and income tax. These are the broad heads which I have made, which are general. You might have your business wherein you might have some specific cost. Please include that, right? These are general broad heads which I always come across, and we always try to bifurcate our cost into these heads. balance sheet related assumptions, as I said, always understand what are your capex and product development costs, what are going to be your inventory cycle. As I said, 2 months, 3 months of inventory always you might need in your in your warehouses. Receivable cycle, MSMEs particularly today, luckily we have a 45-day window wherein within 45 days we get the money, right? But whatever is your actual, if it is 30 days, if it is 15 days, if you feel you are going to be billing in advance, even that you account for it, right? Whatever is your cycle, please account for it in your balance sheet assumptions. Similarly, for payable related, your employees, your service providers, how you are making payments to them in 15 days or on bill to bill basis, account for that in a proper way. And debt and equity related assumptions. How are you going to fund your company? Is it only going to be debt, or is it going to be a mix of debt and equity? That is what it has to be understood. Finally, we have done this, that draw the once all the assumptions are in place, plot the numbers in the P&L, balance sheet and cash flow by linking to the assumption sheet, and your financial model is ready. So this is some brief on how you have to build your financial projections and model, so that you can be ready in some way before going to the investor. Some common mistakes we have already discussed this. Making yearly projections, it's good, but try to break the first year monthly. Second is working capital assessment is not done in a lot of cases. I always see people just straight away come with P&L, capex, that's it, right? Revenue workings, people come to us, okay, we don't have any basis, we just think this might be some of our revenues. Please don't go blankly to the investors. They will literally throw your papers away, right? They want very thorough analysis whenever you are approaching to them. And finally, capex and product development planning. So if you are into research, if you think you are going to be doing it continuously, please put that again as an expense. Don't stop that, okay, only first year I will be doing 2-3 crore rupees and then I might not do. If you are into research R&D, please put that planning into the financial assumptions, so that you will know that how and when you are going to need the capital, right? So this is what we have on the financial modeling side. We will jump to valuation. Before that, if we can take some questions, Jeremy.
Yes, thank you. Thank you. Any folks in the chat, if you have any questions, we've dropped the link. Jigger has dropped the link here to the templates folder, including the presentation here that Arpit has shared. Maybe while you're pulling up the next presentation, Arpit, folks will put a question in the chat. Otherwise, I think we can keep moving on.
Sure. We'll straight away jump to valuation. It's a very
It's been great so far. I mean, this is amazing. Thank you so much.
Yes, absolutely. And the next topic is much more interesting, because I'm sure all the startups are much more interested in understanding valuation, because that is where the money is going to be. So let me quickly go to that slides. Yeah. Is it visible?
Yep, looks good. All right, we have one question here. Let's say we're setting up a steel manufacturing plant, specialized pipe industry. Just as an example, what could be the assumptions for our financial model?
So whenever you are in a specialized pipe industry, first you have to understand who are going to be your customers, right? For example, in steel, there can be your end use can be for thermal applications, for infrastructure, for real estate, right? Understand what are going to be, where is there you are going to sell, right? Then make a list of entire customers. How many, you can even write down the names of customers, right? Because we always encourage that just putting things on air is one thing, but if you write into paper, it will put it in much better perspective, right? So write down who are your target customers, right? In India, we know, okay, for example, there are 50 infrastructure companies, or there are 100 real estate companies. For if you are geographical, if you are set up in Gujarat, for example, within Gujarat how many real estate companies are there, how many infra companies are there, how many thermal engineering companies are there, right? Understand how you are going to pitch to them, what is going to be your sales cycle, right? Because there are already a lot of pipe making companies already into the industry, how are you going to be better than them, right? So that it will, and once you understand that, you will understand what is going to be your sales cycle. Is it going to be 1 month or 2 months or 5 months, right? Once you understand that, then check on your pricing. Again, if you are a specialized steel, you might have a premium pricing also. A lot of times we see companies come to say, sir, I have to be a differentiator, but the way I will be a differentiator is by lowering my prices. Please don't do that. uh, you should appreciate your research. You should appreciate what is the uniqueness of your steel if you are into steel, right? And only if your steel is unique in a particular way that your end consumer is appreciating, have a premium pricing. Today we have seen everyone is ready to pay a price if you are giving them the product which they need, right? So even go with a premium pricing and then build your revenue projections. Secondly, you will have a lot of inventory to be built, because it is not make to order. It might not be make to order. So you will have to have a lot of inventory. So working capital again will be a very big thing in your industry. And third thing is, if you are going to set up a plant, please be understanding of what type of plant you are going to set up, right? And accordingly project for the entire expense. Nowadays, if you are going to do an import of machines from China or any other country, right? Import duties are also very heavy. Account for that also. One more thing is, whenever you are doing all this expenses and income, please also account for your GST expenses also, because sometimes we have seen GST in the initial years as an expense, it becomes a very high cost, right? So please account for that also. Otherwise, you will think, oh, I have not, why has all the money gone into taxes, right? But that is what I'm saying. Please account for that as well, right? So these might help Dhairya, I think, for you in setting up your steel plant. One more question we have, how B2C can analyze TAM. So uh, one way to look at it is, if you are in a particular industry, for example, if you are into a chocolates industry, right? Some niche chocolates, you have to understand what is going to be your entire population. Okay, nowadays it's very easy to say, oh, 140 crores is my entire population. But no, it is not how it is going to be. Your TAM is going to be the exact age group which you feel will actually serve, will eat that particular chocolates, right? Even gender, if you think females may be eating more chocolates, right? Then you have to target, your TAM has to be as proper as possible, right? When you are doing all these exercises. So put assumptions, okay, who is going to be your end customer? Profile, do your client profiling. That is how you will understand TAM, right? We'll look at more questions later, I think. Let's jump to
Yeah, and
value.
also for any in-depth questions, folks, you can reach out to Arpit directly.
Absolutely, always available, right?
So it's okay, I'll put your email in the chat here then.
Yeah, please. No problem at all. Yeah. So next, again, very interesting topic we have is on valuation. Very much required whenever you are going today, especially, and meeting investors. So let's understand. I have tried to brief in this entire valuation masterclass as to what are some basics you should keep in mind, what are some methodologies how you can value, and we will also do a lot of Q&A in this, right? So let's understand valuations. So first and most important thing, why is valuation needed, right? So sometimes people say, okay, one, it is required for compliances, but most importantly, it is required for negotiations with your investors, right? So you should know what is the value of your company, right? So if you are going to an investor will generally ask you, right, at the end of the entire series of questions and everything, they will ask you, okay, what do you think is your valuation according to you? So in order to arrive at that answer, we should know in some hindsight through some research again and some calculations that what is that should we be valued at, right? So most important thing, valuation is required for investor negotiations and for compliances. So let's understand some methods, right? I'm sure you will get a lot of these methods whenever you are doing Google also, right? We'll try to understand all of these in some little ways, that what are these methods, right? So valuation approaches and methods, first is the asset approach. What does the asset approach basically say? Okay, let me also get this also through some Excel working. Just a second. Yeah.
Also, I've
So
shared your number in the chat. So if anyone wants to reach out.
yeah, absolutely not an issue. I'll just share the screen of, yeah. So what is an asset method, right? It is basically, in old times, everyone, whenever we used to ask our fathers or our business owners, what is your business value? They will say, okay, whatever is in my balance sheet, you can look at it, and that is my value. The method, that is also a method which is known as net asset value method, right? We always say that is to be the base value below which you should never ever sell your business or value your business. So plainly, what I've done is put a small balance sheet, some assets like property, plant and equipment, intangibles, current assets, all of these are here, and my total assets are, for example, 1 crore 22 lakhs. I have some liabilities here and some borrowings, right? This is how I am going to fund my business. So what is going to be my net asset is, I will take my entire total assets, reduce it with borrowings, and reduce it with my current liabilities. As simple as that will be my net asset value, right? In this case, it is coming negative, right? Similarly, in a lot of good mature companies, it might be positive, that too in crores of rupees, right? This is something I built for startups, because startups generally the valuation as per NAV is negative. So does that mean my value is negative? No, because I am building the product right now, right? So yeah, my entire energies and entire spends are going to go right in the product development, right? So then how to value myself? Then we just now went through the financial model, right? We have to build your financial model, right? Take the revenues, reduce all your expenses, come to EBITDA, build all these assumptions, and there is a method known as DCF, that is the income approach, right? What is an income approach? The approach is basically taking into consideration whatever your incomes are going to be generated, whatever your cash is going to be generated, right? And you are basically discounting that entire cash flow and arriving at a particular number. For example, in this case, I have taken the entire revenues, I have gone to the EBITDAs, right? Build the capex, reduce them, reduce the tax also, right? These were my free cash flows, right? Don't go into the jargons. That's not. You get a lot of DCF calculators also nowadays, right? So you can straight. But for that, your inputs has to be correct, right? The inputs are revenue, expenses, working capital, capex, right? Put all this into properly, and you will get the equity value of your company. For example, in this case, I am getting the equity value of the company as 23 crore rupees. So doesn't mean that, if you are just starting off, does it mean that, my value is not there? No, it is not like that, right? We always appreciate the research being done, the number of years of efforts being done, but finally it has to be, rewarded through revenue and profits. So that is what DCF basically says, that your entire cash flows are going to be rewarded, and your cash flows will be discounted, and we will be arriving at a particular number. So this is one of the approaches which we call as DCF. Now whenever we do DCF, we discount the cash flows at a particular rate, right? I saw one question in the chat box about IRR, or rate of interest. I'll just briefly run you through what it means. right? So, for example, today in India, a risk-free rate, right? If you want to invest into any FDs, right? The basic rates are roughly around 7%, right? If you see FDs, right? Similarly, if you are investing in stock markets, the basic minimum return that we are getting nowadays is in the range of 13 to 14% when we are talking of long-term perspective, right? Maybe 5-7 years horizon, we are talking. At that time, you are getting a return of roughly around 8 to 10%, right? So now, if you are if as an investor, I want to come into your company, right, and I want to invest in you, do you think I would be okay to have a return of just 10% or 15%? No, I would want something higher. Today, when we are meeting private equity and venture capitalists, the minimum return that they need is 25% and upwards, because they have a life cycle of 7 to 10 years. All venture capitalists, you will see a lot of IPOs recently coming, right? The reason of them coming also is because their investors, the company's investors, are under pressure for exit, right? So every 7 to 10 years, the VCs also have to take the capital back with a particular IRR. And the IRRs which they expect are in the range of 25 to 30%. So always discount your business with around 25 to 30% minimum, because if you are not doing that, then you are not very lucrative for an investor, right? Similarly, again, I have assumed this to be for equity providers. If you have debt, then there is a concept known as weighted average cost of capital. That is a bit complex. I don't want to get into that. It is basically saying give some weight to your debt cost, which may be in the range of 9 to 10%. Give some weight to your equity cost, which is in the range of 25 to 30%, and accordingly you have a weighted average. In a weighted average, your cost will be lower, but you will be funded with debt. So we have to first understand whether your startups will you be able to raise debt, right? Because we have seen a lot of startups coming with that assumption, but unfortunately, in our country right now, we need minimum 2 to 3 years of financials for you to raise bank finance, right? So always, whenever you are taking assumptions in discounting rate or in IRR assumptions, always please be very mindful that don't take very low rate of return, IRRs, right? So finally, we go to one more approach known as market approach. It is similar to saying that, okay, a flat next to me is sold at, for example, 30,000 per square feet. So even I should be somewhere in the same range. There can be some adjustment. For example, if I have a sea view, or I have a garden view, or I have a pool view, I may be increasing or decreasing my multiple accordingly. But I should be in the range of 30,000 per square feet. That is what is market approach. So what are the famous market approaches, especially in startups? The most common is price to sales ratio. Reason being, you don't have profits in the initial years, and same are your competitors also. So price to sales is something which is always observed upon. The other ratios like price to GMV or price to EBITDA or price to book value, these are also further ratios which are being done based on all other for matured companies, right? So but generally, whenever we see startup companies, it is generally price to sales, or price to some GMV, or price to number of products sold, something like. They always come out with some unique multiple approaches, right? So this is what I wanted to share with you about the methods, right? Now let's quickly go back to our slides. Yeah. So as we saw, we explained about base value, that is net asset value approach, market value approach, the market multiple, right? Income approach, the DCF method. And I always say, whenever I meet a lot of startups, so they always say to me, sir, मुझे क्या लगता है कि I will be valued at this amount, So while I am saying DCF, market multiple, and NAV, these are all more of theoretical. What has always been more instrumental is the practical approach. कि सर मुझे ये लगता है कि मेरे पास 10 पेटेंट है, मेरे पास इतने सारे ट्रेडमार्क्स है, I should be valued somewhere in the range of 30 crores or 50 crores, right? In fact, to give you an example, recently I came across one defense company wherein I was valuing them. I am also on the panel of IIT Kanpur. So for IIT Kanpur, I was valuing them. So we valued that company for roughly around 40 crores. It was in the initial stages. However, they had a very big order, which was because of IDEX, which is one of the government programs. They had got around 10 crore rupees of work order. So we had projected valuation of roughly 40 crores. And as normally, we always exchange our notes, and the entrepreneur or the startup, they came back to me that, okay, we want to discuss because this is not the valuation which I expect. I always say we welcome your suggestions, but I would like to understand what is that you have in your mind, right? मुझे क्या लगता है, वो वाला approach क्या है आपका? So he said we should be valued 1500 crores. So I said, humbly, I said, I understand where you are coming from, because recently defense companies are valued very aggressively. However, based on the projections which has been given to us, and based on the understanding which we have of the business, the maximum we could value you is around 40 crore rupees. So this happens. There can be a plus and minus between the investors and the startups. However, please be mindful. 1500 crores, once he said, the investor walked away, right? Understand, you have to be reasonable in your understanding of your valuation. You cannot just throw away any number, right? You have to understand what are the market principles for valuation and only quote accordingly, right? So let me take you to that slide also, because everyone will be curious as to what should be some thumb rules, right? I have given some thumb rules so that you can understand what should be your rough valuations and what should be some practical approaches to valuations. This is, again, please don't hold me to this. This is based on my experience. I have done almost 500 valuations till date, from startups to very big, large corporations also. So based on my experience, I have tried to jot down these numbers. I have seen a lot of companies, whenever they are approaching to incubators, right? Incubators generally, again, this is based on the fund, the Startup India Seed Fund scheme. There are a lot of funds being provided by the government of India, Startup India schemes, right? What they are generally, we see is that, anywhere between 20 to 50 lakhs is what the funding happens, and the rough range of percentages which they expect is roughly around 8 to 10%. So what it translates into is 5 to 8 crores. This is at pre-revenue. You are at idea stage, right? You have just thought of something, you have explored something, you have done some research, and now you have gone to the incubator. This is amazing amount of low amount of dilution, I will say, which incubators are getting. And I will say everyone should explore this route of going through incubators like Venture Studio, right? That, funds are available with them. You should explore it and, try to get that funds, because it is available at a very cheaper cost. Because the same thing, if you go to an angel fund or if you go to some VCs, at that stage, one, they might not fund you also, right? Second thing is, if you go to some angel, he will straight away ask you a minimum, they will say, okay, I want minimum 20% or 30% of your capital. So initially, as I said, don't dilute much, right? Try to go to incubators or some friends, angels who can take the valuation, which is there, and not, roughly around 5 to 8 crores, and not dilute you very highly.
Good question, Arpit. There are other incubators in the ecosystem, and we hear from founders that talk to incubators that are doing an equity for services model. I don't know if you've ever experienced that or worked with founders that are working with incubators that are purely giving space and mentoring or coaching, but do you have any benchmarks for founders that aren't necessarily looking for funding, but they want to work with an incubator?
Absolutely. So service, again, incubators not just give you funds, they give you a lot more things. They give insights, they give services, they give you seats, they give you their entire network, right? I mean, it is AU, or just like you rightly said, many other incubators across the country are doing this phenomenal job. What I have seen in my experience, they are taking from anywhere from 3% to 5% is some equities being taken for the services which they give, right? that is apart from this equity, right? That is a different equity that they ask for. It is generally not included in this because this is specifically against the funds. For the services, like you mentioned, it is roughly in the range of 3 to 5%.
We have a couple more questions here. I don't know if you got to any of these about the value of intangibles such as patents.
See, patents, intangibles, everything is valuable. The problem is how to value them, right? The way it can be valued is, one is all these patents, you have to, make it commercially viable. Even if you have a patent in your hand, it does not translate to value always. It can be valuable, of course, for some company. If you feel is in the similar industry, they may tell you, okay, we see a lot of technology transfer agreements, right? Again, this can be in the range of from 25 lakhs to 2 crores, 3 crores, depending on the product sales that it can achieve. That is why it is very important. Even if you want to sell your patent, or if you want to sell your idea only, even that is possible, luckily, in today's world. And how to do that? You have to build what amount of revenue that can generate, and based on that revenues, you pitch to your target acquire of your patent, that okay, according to me, my patent can get you this much amount of savings. If it is a cost saving thing, my patent can give you this much amount of revenue. So finally, you have to, if you want money against it, you have to convert your patent into a financial term. And that financials can be either increase in revenue or reduction in cost, right? Either of these can be there, and accordingly value your patent.
Okay, one more question before you move on here is about the reserves and surplus, as in losses. And also, can we include promissory notes for orders as part of our assets?
Sorry, come again. Promissory notes as?
Part of our assets.
No. Promissory notes are basically, again, they are liabilities majorly, right? Because you are going to raise funds against your promissory notes. What will happen is, in India, P notes are not that much active as a case, right? Because there are certain statutory lacunas as to how P notes can be structured. That is why there are models like CCPS, CCDs in which it can be structured. P notes are not very, very investor friendly also in Indian compliance situation. So not many are raising funds through P notes. However, if you have P notes in your books, you will have to account for it as a liability because it is a contingent liability for you. And whatever money has come, you have to, accordingly, the assets which are built out of that will definitely show in the asset side.
All right, we have a couple of other more specific questions here. We'll hold off on those maybe until the end in case there's extra time.
Yes, absolutely.
Otherwise, we can continue here.
Yeah, we'll just continue. We'll come to questions in just another 10-15 minutes, right? So just like I said, pre-revenue ideation stage should be valued roughly around at 5 to 8 crores. Especially you should contact incubators for that because they are the right way and right channel for that. Once you have, crossed that milestones of, having the idea actually commercialized, getting some revenues on board, getting some clients on board, right? Getting orders if you are a D2C or a B2C brand, then you will again go to the market for maybe 50 lakhs or 1 crore rupees. At that time, some tentative valuations can be around 15 to 30 crores. See, you will always see here, I am already putting you at a price to sales. If you do a market multiple of almost 15 times or 30 times your sales, this will be depending on the market in which you are operating, right? So this is the general ranges which we have seen, right? Whenever you are in this particular ranges. Similarly, if you are going now more ahead, you are being more mature, crossing all these milestones. Now you actually look at what are your price to sales multiples, what are your price to EBITDA multiples of your peer companies, right? When they have raised capital, what were that multiples? These multiples are not very easily findable. Some websites I can name, like traction.com is one, right? There is unlisted peer is one more one. So you can try to get these in some way. You will have to do a lot of digging to get these ratios, or you can contact your financial advisors who might have access to all these ratios, and he might be able to guide you that what is the rough valuation benchmark you should be having at, right? Mature companies, when we are looking at, they are generally done through a thorough DCF approach and a market multiple approach. They are done through a mix of both, right? So whenever you see listed companies, you see their research reports, all the analysts will give you the DCF, the discounted cash flow method, also their projections year to year, and accordingly they will give you a particular range again, that this is the rough range wherein I like Reliance Industries to be at, or I like Finolex pipes to be at, something like that. So mature companies are morely valued through a market approach as well as a DCF approach. VCs, how do VCs look at? So as I told you, they are looking at a 7 to 8 year window wherein they want to exit at the 8th year, at the 7th year. They will try to put a market multiple, and they will, for example, if your market multiple at that time is and your valuation is coming to roughly around 1,000 crores, after 7 to 8 years, and if the VC feels that okay, he will be left with maybe 5% of equity, because there will be dilutions at every stage, so he thinks he will be valued at 50 crores, and that 50 crores he will discount to today's value, and then he will understand, okay, I can, give somewhere around 15 crores of 20 crores or something like that, based on the IRR expectation of that particular venture capital. So these are the ways in which people are valuing. These are some practical approaches which I have seen. I have gone through you all the theoretical methods, as well as these are some practical benchmarks which I feel have been generally taken as standards whenever, because whenever we see how is an early stage startup valued, very naive of me if I will say okay, it is done through a DCF or through a market multiple. Not possible. We are straight away judging on the you know capacity of you as a founder, right? And the incubators are generous enough to even then give you a 5 to 6 crore valuation even at that stage, right? So these are some practical approaches. We'll also go through some compliances, what has to be done whenever valuation comes. So there are, whenever you raise capital, you will need a valuation report to be done. That will be generally for 3 acts. One is Companies Act, one is Income Tax Act, one is FEMA. FEMA is Foreign Exchange Management Act. We as a country today have turned into a magnet wherein a lot of foreign capital is coming into our country, right? So we have to be understanding of all these compliances also. So whenever you are doing valuation, you need a registered valuer. Whenever you need a valuation from income tax, it has to be through a chartered accountant or a merchant banker. Again, when we are doing for Foreign Exchange Management Act, again it has to be through a chartered accountant or a merchant banker. In FEMA, there is a specific requirement that your valuation report should not be older than 90 days. So it should be as latest as a valuation as possible. What are some of the documents that you have to submit to the valuer? Your latest shareholding pattern. A very important thing here. Again, when we are doing valuation, especially for startups, ESOPs, right? Today, all investors, incubators also have requested all their startups to have a minimum ESOP clause, ESOP of 10% at least. Please be mindful about this because none of them want dilution for ESOPs, right? So whenever you are sharing your shareholding pattern, always account for that in your cap table also. Second is, as on what date, for example, you need a valuation of 31st March or 30th June, please provide your financials as on that date. If you are a mature company, please provide your historical financials so that based on that only we will understand whether your projections are proper or not. Projections of the company for the next 5 years, right? And as I said, 12 months has to be monthly. Pitch deck of the company, most important, what is that you are doing, right? That is very relevant and very important for us as valuers to know. So these are some of the documents that you have to provide to a valuer whenever you are wanting to do your valuation exercise. Some other topics for valuation, some jargons again, pre-money and post-money valuation, right? So we always say, a lot of times this company has taken a 20% stake in a company for 10 crore rupees. So whenever these type of articles come, they are always post-money valuation. right? That means he might have invested 2 crore rupees, right? After which that company is valued at 10 crore rupees, but before which it would have valued at 8 crore rupees. So 8 crore rupees becomes pre-money valuation. 2 crore is the amount he might have invested, and hence finally he gets 10 crore, the valuation of 10 crores post money. This is what is pre-money and post money. Then there are some instruments like CCD, compulsory convertible debentures, very famous, especially with incubators, because a lot of time valuation is not where entrepreneurs agree upon. So we always keep a floor and a cap. What is a floor and a cap? Floor is generally that, something which we as valuers say, okay, you will have a 10 crore rupees valuation, and a cap will be generally what the entrepreneur says, that if he thinks it's a 25 crore valuation, the floor is 10, the cap is 25. So this is how the entire valuation matrix will be, and it will be done at the next round. Whenever the next round of value investor comes in, that is when you actually get this valuation. So this is CCD. CCPS, again, a lot of times instead of debt CCD, people want to invest into CCPS, that is compulsory convertible preference shares. Similar to CCD, the only nature is it is changing into preference shares and not debentures, and hence it will not be treated as debt. Then we have term sheets. Term sheets is something wherein we always say it is a binding agreement for the promoters, for the founders. This is where your salary will also be mentioned, that okay, you will be able to only draw this much salary, right? Not with luckily not with incubators, but this is a very normal thing. Whenever you go to all the investors, they will be holding on to you for all your rights, right? How much shares you can sell, how much, when you can sell, right? They will always have the first right of refusal. All the terms which by which they will be able to bind you is a term sheet, right? Legal and financial due diligence is basically conducted to understand whether the founder or whether the company has done any frauds or anything. That is what is they are trying to check in the legal one. In the financial due diligence, basically they are trying to check whether whatever assumptions you have stated, right, are they at least making sense. So that is what the FDD guys try to do. ESOP pool we discussed, 10% ESOP pool is nowadays a norm, and we always would like to have that on the cap table even before the investment is done. Finally, share transfer versus share issue. This is something, for example, just like Jeremy said, right? A lot of times incubators take equity in lieu of services. At that time, sometimes we have in fact advised that don't put money into the company, take share transfer. That means the promoter will directly sell the shares to the incubator, right? It is an easier transaction wherein no more compliances are required. What is a share issue? Share issue is basically when money is coming into the company. That is when share issue is happening. There are new shares which are being issued to the investors. So these are some just jargons which I thought I should share with you along with evaluation discussions. And yes, I think I am done a lot of talking. We can now discuss, Jeremy, about a lot of particular transactions or particular things which we would like to discuss.
Sure. Thank you, Arpit. Folks, in case you have any questions, you can put them in the chat.
Or we can even unmute if someone wants to discuss. If
Sure, yeah.
it is a
So
possibility.
first question here. We are a D2C company, product company with ready MVP, invested 80 lakh in the process in 3 years of time. We project the sales after launch to be around 12 CR in first year. How should we value ourselves?
So basically, the good thing is you are a D2C company, so the market size is very big, right? What happens is, though you have invested money into your company, you have to see, and you are saying that you are MVP, so you are ready with the product. You will have to go and test into the markets as to how you are going to fare. Though you are saying that you have projected a 12 crore sales, right? Do you think that it will be achievable? Has that been achieved in the past, right? And if not, how are you going to be differentiating and achieving that? And if at all you are going to achieve a 12 crore sale in the first year itself, right? Then definitely roughly around 30 crores to 30, you can do a price to sales of 3 times. In D2C, 3 times is a normal thing wherein you can judge yourself, but that is after achieving. Please understand, during MVP stage, don't value yourself at what you will be after you are achieving your sales number. Before achieving your sales number, don't project yourself at 36 crores. Right now, you can think of yourself roughly around 8 to 10 crore rupees and go to the investor, raise the capital so that you can achieve that turnover, and then maybe you raise the next round of capital at 36 crores.
Great, thank you. All right, so here we have a recently reacquired company. What could be the best way forward? Let's take Sirona as an example. Recently reacquired from Good Glam Group, exited at 450, bought back at around 150. What would we do differently if the company is trying to raise money now? How do we go ahead with the financial model?
So, though if you are a recently bought back company, don't think, I mean, see, Good Glam unfortunately could not execute their plans which they had thought about, right? However, if you think you are in a position to execute the same plan which they could have done, right? You should not value yourself lower. You might have acquired them at a lower cost because there was no option for Good Glam at that time. There was no buyer and you were ready to buy it at 150, right? So it was, I will say, a distress sell that you have got. But when you are again going to the market and when you are going to raise funds, you are not going to be in stress, right? So at that time, you can always raise capital in the normal ranges of, if it was 450 at that time, then it should be at 450 again, right? Build your story in that way that the past should not come as a baggage to you, right? Because though it was done, it I have seen a lot of times whenever it has been bought back, the companies are doing phenomenally well, right? There is nothing wrong in the story of the company. Just as the investors or their main investor group was not able to take it forward, that should not stop you from raising the money at the right matrix.
Okay, here we have how
May I?
will that. Sorry, go ahead. Somebody is there.
Yeah, hi. This is Nancy from Make and Break. I have a small question.
Yeah, please.
We have raised our very first round and we're in the process of kind of doing the paperwork. So we've been asked to do two reports. One is the RV and one is the merchant banker one. Now I have mixed, I'm getting mixed information for the merchant banker one, which says that under some 11 UA, it's not required anymore. The clause doesn't exist, or is it still there? It's required for ITR. I'm a little confused in terms of what needs to be done and what can be skipped.
Are you raising CCPS?
No, it's a pure equity.
So in pure equity, one, what you need is a registered valuer report, that is for Companies Act. For pure equity, you don't need at all a merchant banker valuation report. It has been scrapped, dusted, and in fact it was glorified. That the startup tax is no more applicable. So from 1st April 2025, there is no startup tax at all. So you don't need a merchant banker report. What you can take is a chartered accountant report. A CA will be able to give you a report, and that should be sufficient enough for you.
Got it. Thank you so much for clarifying that.
Yeah.
All right, next question here is, how will the valuation happen when a software, gaming to be precise, company is pre-revenue and patents are not possible, going solely on the basis of early users and vision?
So whenever, as I said, that initially you might not have that many number of users. You might not have, patents. See, patents, honestly, I have seen, sometimes, forgive me for this, but sometimes whenever you are starting a company, patents do hold good, but it is not always valuable at the later stage. You will not see people, doing a lot of selling of patents at the later stage. Patents is okay. Important is how you are good to execute a particular business. If you are a gaming company, look at all the gaming companies across the country, right? You have to see how you are going to get the mass. For the mass, you will have to burn a lot of money, right? So for that, if you think you have a big market size, right, you can always start, because you will have to build milestones. No one is going to give you a straight away a 50 crore rupee check, because gaming companies might need huge amount of capital if it is a B2C gaming company, which I am thinking it is, right? So in that case, start raising small amount of capital, maybe 2 crores or 5 crores, that can be at a 20 crore valuation or a 30 crore valuation. Once reach a particular milestone, then you raise the bigger round of maybe 30 crores or something like that, because you will need that much capital to, market your gaming company to the masses. So initially maybe 20 crores or something you should value yourself, right? And then once you are achieving milestones, then maybe it can be roughly around 60 crores or 70 crores and raise further capital.
Great. We have here, what is good for companies scaling up? Primary sale or secondary sale share? For startup, when and why should we opt for debt instead of equity dilution?
Okay. So what is good for companies scaling up, primary or secondary? Always primary, because during a primary sale, only the money comes into your company's account. Secondary sale is basically founder is cashing out, right? The money goes to the founders and not to the company, right? So whenever a company is scaling up, always you will need a lot of capital, and that capital has to come into the company. The founders might, have some secondary sale for their own liquidity things, but otherwise it is in fact not looked upon nicely if a founder is doing a secondary sale in the initial stages. Second is, when should we opt for debt instead of equity? I will say always opt for debt if it is available to you. Reason being, it is the cheapest source of fund, right? However, just keep it in mind, debt is something you will have to repay, right? Because as a structure, debt has to be repaid, right? So if you think your business is something which is having cash flows and with which you can which you will be able to repay the loan, debt is the best route of funding, right? Equity comes next, because equity is expensive. As I said, the minimum IRRs required for any equity capital investor is not less than 25%, right? So if whenever you get an opportunity to raise debt, you should always go for debt. Otherwise, equity is what you should do. And that is why, in fact, sometimes, CCD also we do, which is a mix of debt and equity, right? So you can look at that structure as well.
All right, we have a couple more questions. When you're breaking into a new field where your current service doesn't exist, at that point, you're still playing with the price that the customers will pay versus how many customers you can acquire. How conservative or optimistic should you be while creating a financial model?
Try to be as optimistic as possible initially, right? Because as I said, you should always, feel that you have made the greatest product in the world, right? So always be optimistic about it, right? Challenge that optimism by all the current products which are going on, right? Check what, while you said that there are not services, you are trying to ask for a service which is not marketable, but see, any service, it might be replacing something else. It might not be the same service, but you might be replacing certain other services, right? Secondly, you can think also how much money you are being able to save for that particular client. If nowadays we do a lot of modeling there as well, that if I feel I am able to save 100 rupees for my client, right, by giving a particular service, I should be able to charge roughly 7 to 8% for that, right? These are some industry norms, again, that 7 to 8% of whatever amount you are saving, you should be able to build to that. So this is also one way how you can look at charging for your service, right? So think of it in that way. Always be optimistic, never be conservative. Whenever initially you are creating the model, then challenge your model with all these questions, and then try to bring down that number.
All right, here we have is a bootstrap startup of biotech-based products. They've invested 1 CR plus in the last 2.5 years. They have roughly sales around 30 lakh. How do you do valuation?
Biotechs generally, the good thing, amount of investment is available, by the grace of Byrack and by the grace of, I think, even Venture Studio has a lovely biotechnology incubator, right? So amount of investment is always getting funded. One, you will have to see the practicality of your end product, right? Whether you will be able to sell your end product in the right way. First year of sales of just 30 lakhs is okay. That's in fact good. But see how much of that can be replicated and how much of that can be increased. Whether you are going to have an L curve, right? From 30 lakhs, will you be able to achieve 3 crore rupees? If you think you have a very good product, then also you will have to understand whether you will need money for investments in capex as well, right? Accordingly, if you think you need to raise around 2 to 3 crore rupees, I think at this stage also you should be valued roughly around 20-25 crore rupees.
Okay, we have Rhythm. Are you raising your hand there?
Yes, I'm raising my hand to ask a question.
Please go ahead.
Yes, please. Thank you. So what I have at my startup, we are building an AI specifically for electric vehicles, and it is in the last mile mobility. But because there is no space and there is this is being catered to for the first time, I am facing a lot of troubles in valuing my company and moving ahead with how should I do it and what valuation should I take any funding from. Until now, we are completely bootstrapped. We have just launched the MVP last week, and we have cracked the AI for one particular brand right now, and we are moving forward to other brands as well. So this is where I am looking for help.
Okay, so AI is a very hot topic nowadays. Anything now, gone are the days when we used to talk that IT or technology were always in. Now AI is in, right? So whenever we speak AI, your valuation goes up, right? So having said that, if you think you have a good market fit, uh, one more thing you can do is see whether there are international comparables also, right? Sometimes we do not relate ourselves to companies out of India. If you think there are someone similar, see, do not always think that there will be an exact replica of your product. If you think there is someone into AI, how is he charging, how is he valued, right? If he's also, go to the business model. If you are into a B2B business model type and you are in an AI SaaS type of a thing, see how they are getting valued, right? You should not always look upon yourself as an AI for an electric vehicle. You can always also look upon yourself as a B2B company, as a SaaS company, and how are you going to finally build in that range? How are other companies valued, right? And again, as I said, always be aggressive in your valuations because negotiations are always going to happen, right? So if you feel you have cracked some company and there is a potential of X number of revenue from that company, see how many more companies you can do, and then accordingly based on that revenues do a price to sales, that okay, maybe if I am able to achieve 3 crores of revenue or 5 crores of revenue and my price to sales is roughly right now at 8 times, so maybe I can justify my valuation of 30 crores or 40 crores. But always do that after you achieve that. In the initial stages, think yourself, you should be okay to dilute at 20-25 crore rupees. Don't go higher than that, because a lot of times, I mean, I always advise a lot of startups. 90% of the businesses are getting killed because of higher valuation expectations. What happens after that when you are not able to achieve certain milestones? A lot of times you get this anti-dilution clause triggering, and then unfortunately you have to shell out a much higher stake than what was earlier agreed upon. So don't be very much thinking in your initial stages about dilution. Think of the benchmarks of 15-20 crores. You should be okay to dilute initially at that rates. Then if you feel you, and put milestones to that, right? And then achieve that milestones and then command a 50-60 crore valuation.
Got it. Got it. A follow-up question. Yes, it is a SaaS-based B2B, which I forgot to mention, because in during the brainstorming of the fundraise round that we are planning to go for, we came to a conclusion that we'll go for a SaaS-based model company and with a B2B client system itself. But now the second question, that follow-up question that I have is, what shall be the percentage that I should, if we go for 20 crore valuation, not more than that, and what will be the percent that should be diluted in the parts for near future to be taken care of?
Great.
Just for the idea.
Yeah. So generally, I always advise in the initial stages, you should try to dilute not more than 20%. So anything lower than that, at 20 crores, if you have someone, if you want to raise 3 crore rupees, 15% or something like that, go and dilute it, right? Because that 2 crores or 3 crores is what is going to take you to the next 50 crores, right? So your dilution should range from 10 to 15 to 10 to 20%. I will give you that range, right? At 20 crores.
Perfect. Got it. Thank you so much. Thank you.
Yeah.
For any further queries, if I'll directly contact you, mail you.
Absolutely.
Thank
Rhythm,
you,
where are
thank you.
you based, Rhythm?
I'm Ahmedabad based, India.
We have a AI demo night on Friday in case you want to. Send you a message here.
Please do. I will definitely join in.
Okay. All right. I think that might. We have one more question here. Can you help understand how to create cash burn for a startup company that solely works on government subsidies?
So government subsidies. So accountingly, if I talk about government grants, government subsidies, they are basically actually treated as revenue, right? They are not debt because you don't have to repay back to them. They are not equity because government is not taking an equity. They are plainly taken in as revenue. And cash burn. If can Khushi, can you elaborate? I mean, can you unmute yourself?
Yes, hi sir.
Yeah.
So I'm an intern at Yhonk. It is a company that is first India's initiative startup that is working solely on reducing noise through all the vehicles that has been created. That is a lot of honks and stuff like that. So they've built a chip that can be put into all the vehicles there based on IoT and AI mixed together.
Great.
So based on that, they're working, and recently I've been hired as an intern to work and build a cash burn model for them. It is a zero revenue company because solely it works on government grants, and their tie-up is solely on all the Gujarat vehicles for the moment. It has, hardly completed a year or two.
Great. So in this case, what you have to build is only expenses. When you're talking cash burn, you are only going to build expenses, right? Because there might not be revenues for your company, because for you, your revenues might be through NGOs or through some some other CSR activities, if I'm
Yes.
understanding it correctly,
Yes,
right?
yes.
So in that case, your revenue is not B2C. It is like a B2B client for you, right? So you may not concentrate more on revenue. What cash burn here means is you have to specifically focus on your expenses, understand what is it going to take to manufacture that device, if at all there is something, right? What is it going to take you guys to install that particular device into all the vehicles of the state, right? What are the approvals? I mean, you have to build in that way the direct expenses which you might have to do it. Do you want inventory? You will have to even budget for that, right? And you have no marketing expense because majorly all your sales are going to be driven through CSR or government things, right? So majorly you will have employee cost, IoT device cost, installation costs, and some admin costs, right? So these are some broad costs which I can think of, and I think that is what will majorly be there in your model.
Yes, understood. Thank you so much for that. Just the model that you've given, the example sheet, does it also have an example of cash burn, or can you share that?
So if you just make revenue as zero, everything else is cash burn.
Same. Okay, great. Got it. Thank you. Thank you so much.
Yeah. I think Dhairya also has some question. Dhairya, can you also unmute yourself? Dhairya, are you there?
We can have another question if anyone has any questions.
Hello.
Yes, Dhairya, you're audible.
Hi.
Please go.
Am I audible? Yes. Hi, everyone. I just had a question. I just had a follow-up question. Actually, I was recently reached out by this firm, which operates similar to Off Business, and this is the company that I was talking about, the piping industry and the steel industry. So I was just thinking if the working capital is already not in a good condition, how can we move ahead with the fundraise, considering that they have already given a lot of shareholding, and additionally, I also wanted to ask if we can improve the working capital in this kind of manufacturing industry, and what would be your thoughts on it?
Manufacturing industry is going to be always working capital intensive, right? So very difficult to unwind it, right? The only way a lot of firms, I mean, try to do it is eventually if you become a brand. For example, a Tata Steel or a JSW, they might be having a negative working capital because they might be taking first all the advances and only then doing their sales, right? Whereas they would be paying to their vendors after 30 days. But having said that, these will be maybe top 2 3 companies. But other than that, all the companies in manufacturing will always have a working capital requirement, because you will need a lot of funds for working capital of inventory, of receivables. So your money is always going to be stuck there. So we always advise working capital funding through banks if it is possible. That is the best way, because all the banks are ready to fund, especially if you are doing supply chain. Maybe you can get some vendor financing or supply chain financing, and I'm sure banks will be ready to help you even at a startup stage. And sorry, what was your second question?
My second question, first of all, thank you so much for explaining this. The other question was, if we could, how would you, advise for a fundraise? Like, would you say that we should raise more venture debt fund? Obviously, you answered that we should go for the banks.
Venture debt, I will not advise that much, because see, venture debt is very good for companies who are making margins upwards of 30%, right?
Okay.
I am not sure in a specialty steel. I don't know. I mean, I may be wrong. Please guide me there. If your margins are above 30%, only then go for venture debt, because venture debt firms have IRRs of 18% minimum, right? So,
Mhm.
so whenever you have to repay them, you have to repay them at 18%. Then it's better than raise equity capital instead of venture debt.
Okay, okay, thank you. Just one very small follow-up questions. The starting financial model, like how you started your webinar, like if I had to take some assumptions, like what could you like just uh, throw a bit light on that? What assumptions could I take in?
So as I said, one is in the steel industry, what can be your customers, right? I mean, you have to mention which industry you are going to target. Whether you are going to target infrastructure, whether you are going to target real estate, whether you are going to target specialty thermal sector or something like that, right? You will have to understand that in the revenue. You will then have to understand how many clients are there in each of these spaces, and how many of them you will approach, right? And finally, you will have to do key. I am able to approach this many clients in this month, and out of that, I am getting a sales cycle of maybe 3 months or 6 months, and then accordingly build the revenue. And expenses side, your I think your costs will are should be mostly sorted out, because your major cost will be all the raw material cost itself, and employee cost. Again, I don't think will be a very heavy cost for you guys. I think major thing for you guys will be understanding of your sales cycle and inventory. These two will be very critical for you guys.
Thank you so much for that answer, and thank you so much, Jeremy, for hosting this webinar.
Thank you. Do we have any more questions? We still have some time. If anyone has any questions regarding this, of course, you have his mobile number and his number, so and his email ID, so you can contact him later as well. Great. So thank you so much, Arpit, for doing this. It was really wonderful. We had a great audience, and thank you for your time. We'll connect
Thank
again.
you very much to everyone at Venture Studio for
Great.
giving me this opportunity, to interact with startups, and having touched upon this subject. Because it was 2 hours, I tried to give as much points as possible in the 1.5 2 hours, so that we don't
Great.
skip up on a lot of things. And the only takeaway I will say is try to dig in as deep as possible into your assumptions, and be aggressive in your evaluations. I think these two things should be good for you guys.
Superb. And we'll keep doing this kind of sessions, and maybe we'll go a level up now to host this kind of sessions with Arpit bhai. Thank you so much.
Thank you.
Thank you.
Thank you very much, everyone.
Thank you. Yeah.
Thank you. Thank you,
Bye.
Jeremy. Thank you very much.
Thank you. Bye.
Bye.